Welcome, everybody, to the Tuesday edition of the Not Your Average Investor Show. Today, a couple of big headlines came out over the weekend that we are going to share with everybody. One is in Fortune magazine, talking about buckle up for more turbulence in a housing market. BoA says it's a housing recession, 1980 style. And then another one is about these big name bond investors that had predicted that we wouldn't get into a recession in 2023, now saying that they are feeling less certain about that, and they're kind of foreseeing recession in the first half of 2024. And what that means, not your average investor style. I'm your host, Pablo Gonzalez. With me, as always, back in the studio. You know what, man? I'm just not taking for granted the fact that we're back in studio.
Dude, I'm with you.
The man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name, named by Big Papa, is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And with us, as always, helping you out, whatever you may need, facilitating intros and content and all sorts of helpful things, and bringing us the moments that matter. That's why we call her MTM, and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
As we transition here into what we're going to talk about before, the roll call, you see the podcast numbers are continuing to rise.
That's pretty cool, huh?
The last podcast predictor thing, I think we're getting somewhere in the realm of around, if we release a podcast, it's going to be listened to by close to 200 people,
nice. Which
doesn't sound like a lot, but in the world of podcasts, it's like a lot, right? Most podcasts get less than 100 listens. We are definitely well above the top 10% of the podcast. I would even venture to say we're somewhere closer to the 2% range. And that is because of our community. You know how I know that, GC?
How do you know that?
Because we get about 179 people a week that come here.
What do you know?
Yeah, so it is our community that's out there. But I also know that not everybody in the community that shows up every day listens to the podcast because they're getting it here.
Sure.
So we have a bunch of other listeners that aren't there. And we just want to tell you that we appreciate you if you're listening on the podcast. And if you're here in the community, send the audio version of the podcast to a friend.
Yeah.
That'll get them to listen. A little surprise for you if you haven't listened to the podcast. I rap in the introduction of it. So if you want to listen to me rap, and you want your friend to listen to me rap, not that this is about me, it's about you, send the podcast somebody. And while you're there, click 5 stars, send us some reviews. We don't have 179 reviews. I would love that.
Yeah, that'd be great.
Yeah, love that. So we'd appreciate it if you did that. You just find that on any podcast platform.
I think the world will be a better place the more we listen to Pablo rapping. So, I just think that's where we go.
Depends on what I'm rapping about and how I'm feeling that day, if I'm really flowing or not flowing. But that being said, when I always flow?
What's that?
The roll call. Woo. All right, here we go. Kicking it off we got our leadoff hitter kicking us off today.
John Henning,
the Remasters kicking us off.
Drew Barnhill,
Chris Lee from Fernandina Beach saying hello all.
Right.
We got a beautiful song in the house. Lita song from Minnesota kicking us off here.
Welcome, Lita.
I don't know if that's going to stick as your...
We can do a little better than that.
She says beautiful always, so I want to... all right, we got it. Javier Yepes. Loud and clear, Pablo. Javier, good to have you in here.
Right.
Maria Totino checking in with us. Good to have you, Maria.
The
Shaw, man.
Nadine Shaw.
And our future guest of property and guest investor of the week on Thursday, favorite name to pronounce. She will be stepping into the lights. Aaron O'Neill on Thursday. We got Matthew Edwards from Virginia Beach. Good to have you in here.
All right.
Rockstar teammate Layla Powell in the house.
JWE
we got Robert Jones from Atlanta, Georgia.
Fantastic.
Oof, man, this is great. Oh, Maria and Jean from West Palm Beach.
All right. Maria and Jean, welcome to the party.
Jean, I've seen Maria before. I don't know if she checked in for you, Jean. So we hope you make it a regular occurrence. We love when the families check in here. Cody Adams, Mama Bear of the Average Invest Show community.
There we go, Cody.
We got the first family of the Not Your Average Invest Show community, the Patriarch and Matriarch, Ken and Carolyn Malin.
We salute you.
We got the MVP a little late in the house. You may have heard of him.
Oh, yes, we do. Mr. Lee Bishop is in the house.
Lee Bishop. Marie Rockoff from Arizona is back. She hasn't been here in a minute.
We have missed you, Marie.
Missed you, Marie. Pedro Nacianceno from Jersey with a Z and 2 E's at the end. We got the regulars, the second family, Gary and Rosalind Riley from Murrieta, California.
We regard you.
We got Greg Troncales with a what is that? I love it, man. I thank Budweiser every day for that commercial.
True.
Who else we got? Nigel Barreto. Nigel,
all right.
It's happening. Time to execute.
All right, Nigel. Is that a new name?
That's a new name, Nigel. New name.
Welcome.
I love it. Nigel, let me know in the chat. What do you mean by this shift is happening and time to execute? I am very curious We got Big Papa in the house. We love it when he calls him Big Papa.
All right, Pops. Good to see you, my man.
Gregg's dad. Throw your hands in the air if you're a true player. We got Laura Colby in the house from Washington State. Good to have you, Laura. We got Sergio Prieto.
Go Gators.
Big win by the Gators. We watched together this week.
We did. That was awesome,
nice.
man. That was awesome. Yeah. Everyone's a big win for the Gators these days.
Yeah. I love it. Who else we got? We got Kyle Barton in the house. He's back from Utah.
Right.
Airbnb expert. Remember?
Oh, yeah, absolutely.
Met him out in Vegas. Good to have you. Eddie Harris from Hotlanta.
There we go.
Good to have you. Jamila Bonahum. Hello.
All right, Jamila. Welcome.
Good to have
all
you.
These new friends.
My ride-along partner, Ride-along Raj in the house.
There we go.
Man, everybody's out here. Victor Mudrick is back from Virginia. Man, this is a great roll call today. I love this. Beth Whitney from New York. That's a new name.
All right, Beth.
New name?
I believe Beth's a client. I'm going to go with that. Beth, let me know. Welcome to the party either way.
You see your Beth client? All right, here we go. Jenny Berger. Checking in, praying for Israel and all the innocent sentient beings.
Yes,
out there.
our
Appreciate
hearts
you, Jenny.
and thoughts and prayers.
Ruben Robies from Philly in the house. Ruben, good to have you. Darcy Laveau from Texas. Everybody's here. Beth has been a client since 2019.
That's what I was thinking. Yeah. Great to have you, Beth.
Good to have you, Beth. All right, GC. Let's talk about our not your average insights here. Man, I am charged up. This is a good roll call.
Mm-hmm.
Buckle up, GC. That's what this headline says over here. Let me share. I remember you shared it with me this weekend.
Mm-hmm.
I saw it. I gave me the jitters.
Mm-hmm.
And it's talking about this like housing recession, but with a caveat, 1980 style.
Yeah.
Does that mean that this is going to be a neon housing recession? GC, is that what they're talking about?
You've heard so many headlines talking about these. Well, it started out the same way: housing turbulence, housing recession. But most of the headlines that we have been pointing out or that you've been reading have been saying something about 2008. That is what has been firmly implanted in many people's minds. Not us here on the show, because for over a year now, we have been talking about how this is not going to be a market crash. This is not going to be a real estate crash anywhere like 2008. And while we were one of the very few here in our community to say those things, what do you know? It's turned out that way, right?
Yeah.
But I thought this article was especially interesting because it talked a lot about what happened in the early 1980s. And it's a great comparable. You can see a lot of similarities between what happened in the early 1980s and even before that in terms of interest rates and in terms of what the Fed did at that point in time. And then it gave us some great insight into how housing reacted. So yeah, this is a new take on what to compare it to, comparing it to the 1980s instead of 2008. And then we're going to talk a little bit about the headline too, and what that might lead you to think as we sort of kind of draw our conclusions here.
Yeah, and that's a good call, man. We've heard so much about recession coming. And when we like to talk on the show, data with perspective. Right. So the data might say that there is a recession coming. But if we don't have the appropriate perspective, our brain goes to recession. Last recession that I experienced was the Great Recession.
Right.
It was a housing crisis. All this stuff happened, and we naturally, react in that way. And recency bias, availability bias, right? Like all the different biases that you study in the brain happen, and we go immediately to that time span. You are right in saying that this is the first article we see that says recession coming, and oh, by the way, this is most like this recession, if we really think about it, which is calling out the 1980s, and quite frankly, makes a lot of sense given the fact that, listen, there is many things that make it very similar to the 1980s, but the idea that the Great Recession was a giant outlier that happens once in a lifetime kind of thing, right?
Hopefully more than that. Hopefully more than that.
Or less than that, depending on how you look at it.
Sorry, yes. We don't want those.
Yeah, correct.
More years than that, more years than a lifetime.
But the idea that the giant black swan outlier recession is not the one that we're going to compare it to seems logical if you just take a deep breath and talk about it, right? That being said, as we know, the revenue model of modern day media, not that the industry is bad, but like the way that incentives are aligned, it is a pay-per-click model. So they're trying to get you to click on something. Therefore, if you're only reading headlines, it's going to agitate you. Once you double check in, then it's a little bit more calm, right? But that's why we like to bring the perspective here on the show. And this one is this idea that it is most like, out of all the normal-ish recessions, it is most like the 1980s because there's a couple of, cyclical, I guess is the best way that you could put it, right? Like these cycles repeat themselves. There is pattern recognition when you can look across a wide range of data, and the most kind of like correlating patterns match to a couple of data points that happened in the 1980s that I think you're going to talk us through here.
Yeah, absolutely. They gave us some great data points that I wanted to share with you. Let's talk about what was similar here in the late 70s and early 80s and how that compares with right now. And then we can also compare and contrast what happened in 2008 as well. So we'll talk about the similarities here. Well, in the early 1980s, the country was dealing with very high inflation. Similar, right? The consumer price index in early 1980 was 14%. And that's when the Fed chair, Paul Volcker raised rates, and that sent mortgage rates, long-term mortgage rates soaring. So they went up to about 18%. So for all of us that, now granted, we've all seen interest rates on our mortgages go up significantly over the last 18 months. But we're at, call it 7%, maybe 7.5% now. And it's less than that for JWB clients. But think about 18% interest rates, right? And Big Papa's on the call here, my dad. I remember hearing stories about how the house that we grew up in, we had, probably close to 14, 15, 16, 18% interest rate on the house that I grew up in. And when I was growing up, I didn't really understand what that meant. But now I think about it, I'm like, holy cow, you had to borrow money at that rate in order to be able to buy a house. So that was a similarity. Well, what happened is the Fed, of course, raised interest rates that high in order to cool down inflation. That's what's going on in present day right now. We've seen our CPI, our consumer price index, drop from 9% now down to about 3%. And that's because the Fed has raised the Fed funds rate so much so that it increases borrowing costs for everyone in the economy, and it tamps down growth, and that brings down inflation. So another similarity to what we're seeing right now.
So similarities are high period of inflation followed by a sustained period of high interest rates.
Yes, and fast high raises to the Fed funds rate.
Rising.
Yes. So when you've heard us talk about on the show and really everywhere, if you're reading economic news, we've talked about how over the last 18 months, the Fed has raised interest rates at the fastest level in the last 40 years. Well, 40 years ago was the early 1980s. And so the last time the Fed did this similar thing was in the 1980s. So it is the best comp. It's the best comparable to what happened in the overall economy and specifically what happened in housing. So let's talk about some other similarities. Well, when the Fed in the early 1980s raised interest rates that much, guess what it did to home sales?
Slowed them down.
They went down. Because interest rates affect demand. They affect affordability, and that affects demand. So, of course, the number of home sales went down in the early 1980s. Building levels, so home building cratered as well, which is what we had been dealing with was in the beginning, especially as interest rates have been going up.
So home sales went down, home starts and construction activity went down. I would assume that likely contributes to the recession of the 80s, right? Because if you slow down construction, that has widespread
it affects so many other parts of the economy. Absolutely. Absolutely. But guess what happened to home prices in the early 1980s, Pablo?
I would assume that you would not have had such a high pitch about it if it meant that they went down.
You read me like a book. Home prices actually remained stable and actually went up. Home prices actually remained stable and then went up. If you looked, go ahead.
Housing sales slow down, construction slows down, housing prices continue to go up.
Yeah. August of 1979, the median U.S. house price was $64,700. In Q2 of 1981, so call it roughly a year and a half later, mortgage rates had doubled, which is exactly what they've done here in the last 18 months. Mortgage rates had doubled, and the median U.S. home price rose to $69,400.
Okay. God, wish I could buy a house for
I know, right? Well, just know in 40 years, people are going to be saying the same things about this right now.
About this, for sure.
But what a great comp. When I read this article, I'm like, wow, the data that I typically share with you is from 1982 on. And so, when this article came out, I said, wow, what a great comp, right? The Fed's action, inflation that the country is dealing with, the rate and the speed at which the Fed increased interest rates, the fact that interest rates on long-term mortgages have largely doubled in basically the same time period, call it 18 months. And then the same thing is happening with home prices today.
Yeah.
Home prices are stable here.
Yeah. And
in many parts of the country. In Jacksonville, I just looked up the median home sales price in August of 2022. It was $355,000. Do you want to know what it is in August in 2023?
$365,000?
It's $355,000.
There you go. Stable.
It's stable.
Yeah.
So, you do not have to, many people are shocked at when we came out a year ago and we said, hey, listen, we do not expect this to be a 2008. We were one of the minority voices there. And people are still looking at what's happening right now. And they're like, I don't get it. I don't get it. But in reality, interest rates going up are only one side of the equation. Yeah. There's a whole nother side of the equation to supply and demand. Yeah. It's the supply side.
That's where I was going to go. Is it the same reason as before, right? Like we've widely talked about this idea, like, yes, interest rates have gone up fast. Yeah. Yes, home sales have slowed down. Builders seem to still be building, so that's different. Yeah. Mm-hmm. And we talk about it, it's the supply side because there is too much demand in Jacksonville specifically, right? Growing population, Zoom trends, like all these different things. Was there also a real big lack of supply in the run-up to 1980?
I wish I had the data for that. I wish we could go back and track months of inventory back then. I don't have that data. Okay. I don't really know.
Okay. What do you know?
What do I know? Mm-hmm. Well, I know on the demand side, what was happening on the demand side was baby boomers were coming of age to be buying homes at that point. And so what this article details is, that shift in demand, that demand from the buyer pool widening by those ready to buy a home contributed to the floor of what prices were at that time. And they also made the connection to what's happening today with millennials. Yeah. Millennials are a big buying cohort, or a big demographic cohort.
The two biggest demographics in the United States, period.
There we go.
The two biggest generations population-wise, boomers and their kids, millennials.
Yes. Yeah. Makes sense. Makes sense. And now millennials are getting to that age. The majority of millennials are getting to that age where they would, be buying homes. Yep. And so there's that demographics there that would aid demand. They talked about that as far as aiding demand in the early 1980s. And they said that there was not an oversupply in the early 1980s. As we start to shift to 2008, it was different, right? 2008, of course, was the other side of the equation when it comes to oversupply. And that was one part of that, along with a lot of others.
So if I'm going to recap here, the reason why, we brought up this article for two reasons. One is the fact that finally somebody started talking about a recession coming and gave some perspective with recession and compared it to the 1980s recession. And the fact that there's a whole bunch of data points that seem to point that this is the most comparable situation. One, high inflation. Reaction to high inflation is rapid rise of the Fed funds rate, which doubled in a short amount of time. That's exactly what we've seen here in recent history. And two, housing starts dropping, construction of housing dropping, housing sales dropping, but housing prices remaining stable. Mm-hmm. And three, a generational shift that happens when a certain generation that is a large swath of the population comes into like peak behavior that requires demand of a certain thing, which in this case is homes. Mm-hmm. In the 80s, it was boomers turning into like peak, needing homes and being parents and whatnot. Right now, it's millennials that are going into this, like mix of like purchasing power and need for home and stability. Right. All those things are happening And we're seeing the same thing. Housing staying stable despite all these other scary things that sometimes would tell you that the housing would suffer and or going up in the majority of the country. And that is really, really interesting, right? We are not in 2008. If we're headed into a recession, you want to start thinking we are closer than 1980. So what can you learn? Right. The other side of the reason why we brought up this article is because it said turbulence ahead for the housing market.
Yeah.
Can you describe what they meant by turbulence?
No, because when I think of turbulence and when I think of housing recession, like they put in the headline, I would think of, decline in value. If you actually read the end of the article here, it says, Bank of America's most recent prediction is flat growth. Yeah. So 0% growth is what they expected in 2023. So I just don't understand why they title it this way. I mean, I guess I kind of do understand why. It's to get clicks and things like that. But, it's just weird. If you would describe anything else probably in your life as saying turbulent or recession, you would expect that would lead you to the conclusion that home values are going to go down or values of whatever you're talking about would go down. Yeah. In this article, I just think there's a common there's just a miss when we're talking about housing. When people talk about the number of home sales going down, for some reason, they call that turbulent or housing recession. But that would be like the number of activities going down in anything that you're describing, but the value of that activity is staying flat. Yeah. And so I don't call the value of that staying flat and Bank of America coming out and predicting that the value is going to be flat. I don't call that turbulent, and I don't call that a housing recession. Yep. So I don't know why you headline it like that, other than to get eyeballs and clicks. Well, the community has a couple of ideas. There we go. Drew Barnhill, ringmaster of the Not Your Average Investor community, he says, remember, the person who writes the headline is not the author of the article. That is something that we forget, right? Great point. We have special folks, headlines to garner interest, and Not Your Average Guest, which brings up two great points if I'm thinking it's the same Not Your Average Guest. By the way, if you check in from the text reminder, you're not your average guest. So unless you tell us who you are, I can't call you by name, but I really appreciate these contributions and I want to acknowledge you. But saying turbulence will be loss of construction jobs and demand. This may be good time for home remodeling and upgrades, which is maybe good news for those of us that own rental properties, right? True. That's some slight differences here. So when I talked about how, construction paused or stopped here in 2023 and how it really cratered in the early 1980s, a little bit different here. So the land sales have actually gone back up. Construction is continuing to happen. It's because there's a big opportunity now for building of new homes because there's such a limited supply of existing inventory. So it's not really playing out like the construction industry is cratering here in 2023, specifically because home builders have this opportunity because there's just very little existing inventory. Yeah. But I do like the point of view that turbulence could mean beyond just home values or, and that makes a lot of sense. So something good to keep in mind. Leslie Wilson, the real estate maven from the mountains of Colorado. Her well. She also says we also had the savings and loan crisis in the mid 1980s. Do you know about that, GC? I don't know that much about the savings and loan crisis. Yeah, I know enough to be dangerous. Yeah. How do you understand it? Man, so the savings and loan crisis. So there were regulations on savings and loans. Used to have savings and loans, which were just different types of banks or credit unions and things like that. They had to operate by a set of rules that made it almost impossible for them to operate when the Fed raised interest rates like it did. And, that's a general thing. So, I mean, feel free to chime in for those. But basically when the Fed, it broke the savings and loan industry because the Fed had regulations on how they had to operate and lend money out. To where when the Fed raised interest rates, raised the Fed funds rate as much as it did, it became a crisis for that. So you can think about what happens if a bank goes under now and then there's a potential bank run. Yeah. So that crisis largely happened. Yeah. And then it affected the economy and sent another reason why the economy went into a recession. Tell me how I did out there. Did I do a good job on that on the spot? Let us know, Leslie, or anybody else in there that remembers it well. I mean, that was like late 80s, right? So I was in like almost 10 and you were like 4 or something like that. You were like 22 and I was, I was young. There's another good point here by Not Your Average Guest, which is a difference
the higher prices ratio now is about 50% higher to median income compared to 70s and 80s. So the price increase narrative may seem unlikely, maybe stagnant price possible due to high low rates in past few years. What they're saying essentially is like one key difference is our wages back then compared more favorably to the actual price, and our wages have largely stagnated. Yeah. So I think that's a good differentiation within all these data points as well.
It's a good point, right? It gets back to home price affordability. Mm-hmm. And, we've had home prices go up tremendously, mm-hmm. right? Especially over the last 2-3 years, 40-50%. And we now have interest rates that have doubled, yep. So home price affordability is a challenge. This is all stuff on the demand side though. Mm-hmm. And so while that is a really good point, we got to think about the supply side, yep. right? Supply side talks about how much inventory we have and does it support the sales that we have. A normal market would have between roughly 6 to 7 months of inventory. And anything below that would it would indicate that we don't have enough inventory to support the number of sales, which would lead to higher than average home price appreciation. And we're in the threes. We've been in the 3s, 2s, even 1s, even lower than 1 mm-hmm. for the last couple of years. And it takes a long time to build your way out of that.
Yeah, totally.
So that is going to be here to stay. So it's a good point. Home price affordability is a very big topic. I get it, but more light needs to be shed on how low of supply we have, yep. because equally, those are both the hands that guide pricing, and the supply problem is a big problem, and it is a much harder problem to solve. Like, how do you solve the home price affordability problem?
You gotta have more availability of home, like more housing offerings, smaller homes, stuff.
That's all on the supply side. On the
raise wages.
Yeah, you could do that, right? Raising median incomes will help support home price affordability. That's the demand side. What's the easiest way to make homes more affordable?
I'm blanking out here. I feel like I should know the answer.
I'm just throwing you out there to the wolves here. Yeah. It's not intuitive. It's not intuitive, but you've got everything that I've been throwing at you lately. So every once in a while, I got to throw one out there. Yes. How about the Fed dropping interest rates?
Yeah, of course.
Nobody believes the Fed really wants interest rates to be this high forever. Yep. Eventually, the Fed is going to drop the Fed funds rate, and that will ease up home price affordability as well. Raising median incomes is the long-term solution, like you said, though.
As we talk about this whole idea of the affordability piece, it also makes me think of, hey, not all housing stock is the same here, right? Like somebody said earlier in the chat that in the higher echelons of home pricing, there has been less stability and like some dips. And what we talk about a lot is this idea that the workforce housing sector is uniquely resilient as a sector, as an investment, as a store of value, because in a world where things are becoming more and more unaffordable, that lower, that affordable, there's two definitions here, right? There's affordable housing and there's workforce housing. Workforce housing is essentially workforce housing for people that make 80% the median income. Mm-hmm. And then there's affordable housing that's less than that. That workforce housing and below, there's always going to be people that are trying to get there, that are moving into workforce living. And then during hard times, there's people that kind of like graduated up an echelon of housing that hit hard times that have to recede to that workforce housing. Whereas in the above median income, the higher levels of income, there's less of that, right? Mm-hmm. There's only downward pressure, not upward or downward, right?
And let's think about why we love to buy investment properties in workforce housing neighborhoods. One of the 5 profit centers is net rental income. Mm-hmm. What that means is when you buy the house as an investor, your mortgage payment is lower than the rent that comes in every single month, right? The rent is higher than the mortgage payment, saying it the other way, and that creates positive cash flow for you. So there's always a financial incentive for folks to get in a position to buy houses in workforce housing neighborhoods. Yep. It is not the same when you get to upper echelons of home buying. The most expensive homes, the opposite is true. Yep. Right? The rents do not support what the home mortgage payments would be. And therefore, you don't have as much of an incentive or as much demand for that. It's not as resilient.
Yep.
And so you take on more risks, the higher the type of home prices and type of neighborhoods that you get into.
Yep, makes sense. All right. Right along, Raj has a really good question here in the Q&A.
Wonderful.
He's asking, home prices are holding up due to low inventory. At the same time, demand is low currently. When the demand goes down, DOM and MOI, what's DOM? Days on market.
Mm-hmm.
And MOI, months of inventory, goes up with slight increase in supply. Airbnb properties are underperforming currently. What happens if some percentage of Airbnb owners list their properties for sale?
Yeah. If more Airbnb owners list their properties for sale, you would see supply go up if we held everything else constant. Now there's a million variables and it's not going to be held constant, right? A small tick down in interest rates. We saw this earlier this year. A small tick down in January resulted in huge demand increases and huge mortgage applications going up. So there's a whole lot going on. But to your point here, if there is a new supply amount coming online, whether that is Airbnb or whether the red tape of building is removed, so it makes it easier for builders to build more homes, those are things that would increase supply. And that's a good thing. Overall, we don't want to have this dearth of supply forever. So this is a good thing for our overall economy. There's a way for supply to go up, in essence, double than what it is right now, and still to see normal home price appreciation. So I wouldn't be, concerned that there's going to be this glut of Airbnb properties on here and it's automatically going to take your months of inventory so high that would then lead to a decrease in home prices. But, I think it will, incrementally add to the supply level.
Yeah. And I saw that, Kyle Barton checked in earlier. He's an Airbnb expert. He's in the chat. I would love, Kyle, if you're there, engage and give your thoughts. It also makes me think of the idea of, again, not all real estate classes are made equal, right? Like this turbulence, these like high interest rates and, what's coming from this. I wonder what all these things mean for Airbnb. Does that mean that it's going to perform or not, or how you adjust those expectations, right? So like, I think more than anything, what we love to bring is a perspective of like how to ask the questions, right? Like, I don't think you and I are gonna know how the 80s compare to today and what will compare to Airbnb versus other things, right? But like the idea of just like, when you're reading this stuff, what to look for, right? Like there is supply, there is demand, there's data points, and then there's other trends that are happening. Mm-hmm. As far as like really consistent asset class, the workforce housing asset class has these like insulating kind of qualities of consistent demand. Mm-hmm. And then you add the idea of like affordability crisis, right? Will only make that more attractive. Mm-hmm. When you now look at it per market, right? Like different markets also have different supply and demand. And while in general, millennials are coming of age to buy homes, so that's going to be a macro trend. So there's going to be more demand of like peak home buying. There also happens to be in a city like Jacksonville, a local macro trend of very, very rapid population growth, existing demand. We also started below the affordability, like in the low affordability side. Right. So there's more upside to go, which creates another one. Then you think through the idea of a well-rounded economy of logistics and military, government, healthcare, finance, and fintech that is here, along with the long-term bets that are coming of what's growing there, right? With what is happening with autonomous driving vehicles, with the AI filtered campus, like the AI powered finance and healthcare program that's coming to downtown with University of Florida. And then, oh, by the way, the idea that there is a downtown that is about to cross a certain threshold that we've seen across a bunch of other cities, that when it does, raises median incomes, increases the immigration rate, increases the value of properties as well, right? So like, it's just like all these data points, you want to paint this tapestry.
That was good.
We know this one really well.
That was really good. That was really good. That was a lot of good stuff that I think that was like the last year of shows. You just put it into like a 3 minute section there. I want to let everybody know, if you have your money in single family rental properties right now, you're in a position of strength.
Yeah.
You are in a position of strength.
Mm-hmm.
And you can't say that about many places right now. So that's not by coincidence. It might be because, you are here, right? It's you're educating yourself, or you could look at it because this is an asset class that has performed. It's a position of strength no matter what is thrown at it, whether it's recession, whether it's, pandemic, whether it's eviction and foreclosure moratorium, right? This is not a coincidence that this is an asset class that performs well and mitigates risk and puts you in a position of strength, especially when, the world is on fire largely. Yeah. So I want to commend you guys. You guys are here and you are in a position of strength. There are always going to be things that could go wrong. We can always hypothesize what could happen here. But there's, just like you did in that little 3-minute monologue there, you could probably choose 5 other hypotheses that would overcome that negative one. And at the end of the day, none of those are going to be 100% right. It's going to be a little bit of this, a little bit of that. But at the end of the day, you've got an asset here that is strong, that has performed well, and you should feel really good about it.
Cool. All right. Kemeline, patriarch of the Not Your Average Investor Show First Family, asks, does JWB sense a downturn in housing demand and adjust their building activity downward?
Do we sense a downturn in housing demand? I mean, not from this point. I mean, we've kind of seen how the market has responded to, 5.5% interest rates, 6, 6.5, 7, 7.5. I mean, interest rates are the highest that they've been in however long now. And so, we're still on pace to sell 300-400 houses this year. So we've prepared appropriately. No major changes. We're kind of sticking to the plan that we built last October. And I'm going into business planning at the end of this month for 2024, and I'll let you know if anything changes there. Yeah,
just to highlight that, right? Because I think there's 2 parts of that question. It's like, are you sensing that? Or maybe the question is, if you were to sense that, would you adjust your building activity downward? And what you just said in that answer is, y'all are going into business planning right now, right? Like, and you business plan every single year. You guys, your business planning process is something I've been fascinated with since day one, because it's so deliberate and precise. And quite frankly, last year, you predicted you were going to sell fewer homes, but you were still outperforming the amount of homes that you thought you were going to sell last year, right? Yeah. You want to say a little bit about that and kind of like about the business planning process?
Yeah. I mean, it's uncanny, actually. I should probably knock on some wood here, but we business plan every year, like Pablo was saying. So last October, we mapped out how many sales we would have by the end of September. And we were just in our meeting every month. We have a roundtable with everybody in our company, and we share all of our metrics, and we share what did we say we were going to do by the end of month 1, month 3, month 5, month 7. Well, it was end of September time, and we shared what did we say we were going to do for sales, and where are we? Would you guess we were 100% spot on?
Really?
Yeah.
Oh, wow.
Yeah, it was kind of crazy. So, part of that, what we did though? Whenever we do business planning, we assume a very conservative stance. When it comes to income, we are very, very conservative about putting any income in our business financials planning for the future. We are super conservative when it comes to income. Expenses, we're gonna make sure that we plan extra well to spend money. And what that does is it forces us to, generate enough income to withstand expenses that we know we're going to incur, and it forces us to have a better, more risk mitigated business plan. And so when we come to a year like 2023, if you go back to the end of 2022, a lot of people were saying, oh, the interest rates that we have at the end of 2022 are going to go down. They're going to go down. And many people assumed that the real estate market would get a bump, and it would be easier to sell homes in 2023 than it was, towards the end of 2022. Yeah. But we did not buy into that, because the risks of buying into that could be catastrophic depending on how much you bought into that. So at the end of 2022, when we built the business plan, we said, listen, we're going to assume that interest rates are what they are and they're not going down. What they've actually done is they've gone up. Nobody was thinking that, but at least we didn't assume they were going to go down. So we were very conservative with our numbers as far as how many home sales we were going to be able to sell. And I think, and I know this year, as we go into planning for 2024, guess what we're going to do when it comes to interest rates?
I would assume you're going to forecast high interest rates.
We're going to forecast it exactly the way it is right now. And we'll, of course, we'll build our sales and revenue numbers based off of that.
Okay. Yep. Makes sense. What impresses me most about the way that y'all business plan, right? Because as I've gotten to be on the show, I've gotten the chance to like pick your brain on like how to forecast for my business and whatnot, right? Like that idea of never counting on a revenue stream unless it's a proven revenue stream,
right, and
always counting on cost plus other things as a way to mitigate is huge. And I think that kind of like you said, it can have catastrophic implications, but to you, I know that the way that you think about it is more personal than that. It is not just catastrophic implications for the business. It's what's the impact to the team if we are bringing people on and assuming that we're going to be able to like do all the stuff, and then you got to let people go, and how that affects the continuity and the communication and the client experience and the resident experience. And at the end of the day, the culture here, which to me is the ever-growing competitive advantage. Yeah,
really proud that we went through the pandemic and never once had a layoff. Yeah. Really proud that, we're a real estate company that, is, we are affected by interest rates, just like every real estate company is affected by interest rates. But because we plan appropriately, there's real estate companies that are letting people go left and right. No layoffs for JWB. It's very, very intentional, because at the end of the day, you all have the decision to buy and invest in real estate any number of ways. You choose JWB because of the experience. And the experience is what allows you to stay in this game for a full market cycle so you can get all 5 profit centers. The reason that the experience is better here is because of our team and our culture, and our team and our culture depend on trust. Yep. And our team has to trust that this company has their best interest at heart. If you don't plan appropriately and you have a layoff, it takes years and years and years to rebuild trust within an organization. And so that's why we take it so seriously for internally, so that we can make sure we produce for our clients externally, and that you guys have that experience that you're coming to JWB for.
I've always thought that the book on JWB is a book on long-term thinking, man. That's a really good example. All right. Jim Kirko here, Hall of Fame first baseman, has a question. Can Gregg press the reset button and take us back to early 2020 so we can all get a redo? If he did that, most of us would sell our wedding rings, children, cars, etc., to buy more rental houses. Thank you for the consideration. What do you say to that, GC?
Oh, man. I just remember over and over and over on the show, we just talked about how he said, the deal is the debt. Yeah. The deal is the debt. The deal is the debt. Stop talking to me about how you think home prices are too high right now. The deal is the debt. And we said in 3 years, you're going to be kicking yourself that you didn't buy more, because that was a truly historic time. So I don't want to bring it up too much. I think it kind of makes us feel sad. I don't know if we'll ever see, interest rates on investment properties in the 3% again. But would a redo, does it make us feel better, or does it make it feel worse?
I don't know. I mean, Kirko is asking straight up. Is your answer no?
Oh, would I do it? I thought you were just trying.
Do you have a reset button or not, man?
Oh, do
Stop
I?
Sleeping on it.
Here's the deal. At the end of the day, while there was a very time-sensitive nature when it came to the debt, that I don't think we're going to see debt that low again. At the end of the day, real estate, the same story is going to play out over the next 10 to 20 years if you invest in Jacksonville real estate as it was for the last 10 to 20 years. I mean, it really is going to be a cycle. I say that, and then people are like, oh yeah, well, it's cyclical. That makes sense. But for some reason, people still try to think, oh, well, it's not going to be the same way over the next 10 or 20 years as it was for the previous 10 or 20 years. And it's going to be. So while we can look back and think about how great it would have been to buy before, home prices went up 40%, and while interest rates were incredibly low, at the end of the day, if you buy today, the story is going to end roughly the same way. You're going to get, call it somewhere around 9-10% returns year over year over year. Your assets are going to perform quite well. Don't know exactly how it's going to get there. I don't know exactly what's going to happen over the next 10 or 20 years, but that's the story. That's how it ends. And so looking in the rearview mirror can really be detrimental if it changes your perspective and somehow cause you to think that today it's a less better opportunity compared to your other opportunities.
GC, I wonder if the term cycle is detrimental to this.
Yeah.
right? Because I think when people think of a cycle, they think of something that goes in a circle, and it goes up and down and resets and goes up and down. And while that's actually true in other things that we think about, it really is a cycle. I would say that the real estate market acts in repeating patterns.
Yeah.
Right.
I see what you're saying.
And if you're looking at it in a long enough perspective, it's just one pattern. Right. As opposed to the idea that it's like, oh, well, maybe if it's a cycle, if you just think about it, you're thinking about a cycle, you're like, well, dude, then I should just wait till right here so I can get all this.
Yeah. As
opposed to jumping in. Right. But I think most people, it's the whole adage of they look for whatever reason to wait to buy real estate, when in reality, it should be buy real estate and wait, because it is extraordinarily consistent, because it has proven time over time to be the greatest wealth creator for Americans, because most Americans believe it's the greatest wealth creation mechanism, and yet not even the majority of Americans actually hold it, right? So to me, the language of cycle may or may not be helpful to this thing. It's more like, hey, how can you just get in on the ride and be along for this recurring pattern?
I think you're right. The idea of a cycle leads people to believe that there is going to be a loss somewhere, followed by a big gain somewhere. Mm-hmm. When we're talking about a real estate cycle, it's like, we're not, generally real estate may go up at this rate, right? Mm-hmm. But this is flat. This is whether you make money or lose money down here. Most cycles are compared to this right here, boom, up and down right here. Yeah. In real estate, it generally goes up like this, and your cycle is above or below the expected growth.
Yeah.
So when you use cycle, you probably invoke that fear of, market values going down, and that house somehow is normal. But when you look back and, I know the data since 1985, we've only had 1 year on record in Jacksonville where home values have gone down more than 10%. Mm-hmm. You take out, and obviously there's losses more than that in other places, but not in real estate. But you start to, and the only time home values have actually gone down in Jacksonville real estate is during the Great Recession, which was caused by real estate. So it's completely not normal for it to go down. But to your point, when you say cycle, that's a common thing. I'll have to think about the rhetoric there.
Yeah, we should think about that. Jim does say that if you reset it, he promises to send you his Hall of Fame first baseman glove.
Oh, all right. I'll have to talk to the power at the feet.
You got 100 people. Somebody should get started on a flux capacitor.
All right. We'll
R&D department, you have one?
It's business planning time. It's perfect time to bring it up.
All right. Thanks, Jim. Jim, I appreciate you finally acknowledging and playing along with that joke, my friend, because we're very insecure about how you take it. But we love it. And we love you being here. And we love that you bring your son and all that stuff. All right. Ken Moline asks, Gregg, for the fourth quarter 23, would you advise doing a cash out refi on an existing home and adding to your portfolio? Or would you advise waiting to see what the financials are mid 24 and make investment decisions then?
Ken, great question. Of course, it's going to take putting some numbers to this to make sure that it makes sense for you. I would highly encourage you to reach out and talk to the team, and we can put some numbers to it. I'll give you a couple of examples where it would make sense and maybe where it wouldn't make sense. So let's say that you're a client and you've owned your home for 10 years, and you've built up $100,000 of equity, and let's say $200,000 of equity. Let's go big here, right? And your interest rate on those loans is, call it 5%, mm-hmm. on your current debt. Well, in that case, you could really tap into that equity, call it $150,000, $200,000 of that equity, and bring that into assets, JWB assets, where you could earn 9 to 10%. Right? If you don't use that, it's basically doing nothing for you. So your opportunity cost is, call it 9 to 10% a year if you don't do that. And the reason why we need to pay attention to the interest rate that you have on the debt currently is because we have to think about what's the likelihood that you might be able to get that interest rate again in the future. Or you just have to take into account the cost that your interest rate in the future for your refinancing is higher. I think I said a whole lot there. Here's the thing. If you have a really, really low interest rate on your existing debt, if it's in that 3s or 4s, it's going to be a factor of how much equity you can pull out to make it make sense. And also, what is your investment horizon?
Yep.
So the lower your interest rate is on your existing debt, the higher the equity should be. And the longer the investment horizon, the more that the more you need to understand what the cost is for your interest rates. Long story short, I mean, interest rates are going to come down at some point. Even if you refinance right now and you took your existing debt interest rate from, call it 5% to 7%, I mean, most economists believe that at some point, the interest rates that we have are going to come down and probably come down somewhere close to 5%. So you could refinance again in 2 years or 3 years or however many years in 1 year. I don't know when it's going to happen, but you could get that 7% interest rate and bring it back down to 5%. And you would have unlocked this equity, this, call it $200,000 that you could have put to work earning 9 to 10% for, call it a couple of years. And you also have to think about how much are the assets going to cost in the future as well. So your cost basis on the assets is a lot lower. So that's an example of when it would make sense. When would it not make sense? If you have interest rate in the 3s, it's a 30-year fixed rate interest rate in the 3s. You have, $50,000 of equity that you really could pull out. Does it make sense for you to pull that out in order to, be able to buy an asset? It makes a lot less sense at that point, especially if you have a long horizon, because that 3% interest rate is going to serve you there, hopefully for the next 10, 20 years. So it makes less sense if that's how the numbers work.
That was not an easy answer, man. Good way to. Drew Barhill approves. Very well said, Greg.
Cool.
Good running.
I feel like
scenario.
I kind of babbled a little bit there. Sorry about that, boys.
I thought it was pretty. It was a 10 out of 10 difficulty of like explaining that. The easy button, Ken knows because he can call his portfolio manager and you can talk through it. But if somebody's listening to that, you have equity in other rental properties, you're debating on whether it's time to like re-up and get back in. That is exactly what going to chatwithjwb.com will do for you. You're going to hop on with somebody that can run those numbers for you and take you through a couple of those different scenarios and really understand if that makes sense for you or if there's other options to get in there that isn't refinancing and stuff like that. So chatwithjwb.com to handle that personal situation. JC in the chat. I can't remember who normally defaults to JC. I know it's a regular of ours here. Also says you could look at all-in-one loan kind of thing too. So there's a couple different options that if you go to chatwithjwb.com, plan a call, hop on with the team, they can help you through. GC, let's hit this last story real quick.
Sweet.
I think we're going to just turbo this story. I shared it in the chat, but essentially a couple of really smart bond investors and predictors of the economy. This guy that works for Goldman, another guy that works for OCBC Bank that had essentially said that they don't see recession coming in 2023 and they were out on a limb and they were right. And now we're saying they see a much more likely first half of 2024. I shared it in the chat. What do you think about that, man?
I feel that, it's interesting. We did a show, Not Your Average Insights, probably a month ago, maybe 6 weeks ago. Yeah. And it was the vibe at that point was the talking heads out there were saying, oh, it's a soft landing. It's a soft landing. It's a soft landing. We're kind of going to a soft landing. And I feel like over the last couple of weeks, there's just been this growing pessimism of, are we actually going to get a soft landing or are we going to go into recession? And the reason why many folks are now going back towards recession, especially in 2024, is because there's this feeling that the financial markets and people in general finally believe the Fed. What the Fed has been saying for a long time is that they were going to keep rates elevated, even if it meant bringing pain to the economy, because they are going to have a hard time getting inflation down. And the Fed has been saying this consistently. The Fed has said, we're going to keep rates elevated. We're going to keep rates elevated. But for so long, the financial markets didn't really believe it. They didn't want to believe it because it's, to their incentive to not believe it. But it just seems like, and maybe it's just me, I'd love to hear everybody else's opinion here in the chat, but it just seems like finally now people are starting to believe this. And you start to see this with what's going on in the markets right now. And the yields on bonds have gone up tremendously. And you just see money starting to move in accordance with the idea that rates are here for a long period of time to stay high for a long period of time. And if you believe that, which is what these very sophisticated bond investors are looking at, they understand that the ramifications of borrowing costs being so high when the Fed funds rate is so high for so long, eventually things break in the economy. And the costs for businesses are so much higher, and businesses might be able to sustain it for a little while. But if you start to think that this is going to be the way it is for a full year, things will break in the economy. And that's why, a lot of folks now are saying recession 2024. So my advice would be think about where your money is and think about how assets do in times of recession, which is the same drum that we have been beating for over a year now. And we know that real estate does quite well in recessions. 5 out of the last 6 recessions, home values have gone up in Jacksonville real estate. And the reason, and people might not know this, but the reason is because when there is a recession, what does the Fed do, Pablo, in terms of interest rate?
Generally lower interest rates.
Right. A recession means there's not enough growth. There's two quarters of negative GDP growth. So what does the Fed do to kickstart the economy? It lowers interest rates. What's an asset class that is really positively affected as far as values and demand when interest rates go down? Housing. So housing does really well in times of recession. So I agree with these very astute investors out there who are predicting that we're going to see some tough time in the economy. Don't know when. 2024 sounds right to me. And I would be preparing myself appropriately and being in hard assets like rental properties. Yeah.
My overall take on this is going back to Kirko's question of the reset button and you saying that in 2020, the deal was a debt. I feel like right now the deal is peace of mind.
Yeah.
How long are we going to be talking about this, right? Like how long are we going to be fearing an upcoming recession, trying to milk out whatever time is left in this short horizon to then time something to them, whatever. If I'm looking to invest money right now, I'm really pricing in ease of going to sleep at night, knowing that I'm in something that for the medium term, I'm going to be happy with. And for the long term, I'm going to be ecstatic with, and it's not going to cause me headaches.
Why is it so hard for people to put a value on that?
I don't know, man. I think we get enamored with like action and making the right choice and like the juice.
Yeah.
I think we're somewhat addicted to anxiety, to be perfectly honest, with all this stuff. So I don't know, man. To me, the deal was a debt in 2020. The deal in end of 2023 is peace of mind.
I like that.
Get a peace of mind in that deal.
I like that. I like that a lot.
So, and we know that real estate does well. We know workforce housing specifically does really, really well. We know that Jacksonville itself is positioned to do very, very well over the next 5 years. So, if you agree with that stuff, chat with JWB.com. And you get that conversation started. GC, we're back, awesome, baby. Dude. We're back, baby.
It's awesome.
Not Your Average Insights. I love Not Your Average Insights. I love being in the studio in here. I love that we had 70 plus people at one time at some point, which makes you think that we've actually had like 80 or 90 people roll through here today. And I'm incredibly just like humbled by the fact that you take an hour out of your day, the middle of the work week on a Tuesday, hang out here. The chat today was on fire. Just tons of great value, people exchanging value. And I couldn't keep up with most of it, but I could tell that great stuff was happening. Thank you all for being here. You are what makes this show great. And speaking of what makes this show great, on Thursday, what do we got coming up?
Oh, boy. We have a guest investor, a JWB client, royalty here in the Not Your Average Investor community here. We have Miss
Erin O'Neill stepping
into the light, and she'll be our guest on Thursday. I have gotten to know Erin over the years, and she's just a bright spot wherever she is, and she makes such an effort to be a part of the community. She's been here on our tour. She's, the Not Your Average Investor tour, which we'll be doing another one here in February. So
we're finally floating a date that we're really dialing.
We are.
We've heard you. We're really testing this data out right now internally. So
it's likely it'll be in February. It's likely it'll be in February. We'll hammer that down and let you all know. So such a special client with an incredibly amazing story to share on Thursday. So can't wait to have her.
Can't wait to talk to you, Aaron. Can't wait to see you all on Thursday. And from here till then, remember one thing.
Don't be average.